$410 million left US Bitcoin ETFs in a single day. Institutional demand just flashed a red warning light. Is this a hiccup or the start of something worse? The answers aren't what the headlines tell you. Hi, you're watching EconomiQ. No spin, no hype. Today we break down exactly what happened, why flows matter more than price headlines, and 3 signals you must watch. I'll show the real mechanics behind ETF flows and why the last signal changes the game entirely. On February 12th to 13th, US spot Bitcoin ETFs recorded roughly $410 million in net outflows. A concentrated move where the biggest funds saw the largest redemptions. That's the concrete event everyone's talking about. We're going to dive into 3 key points today, and trust me, the last one is a real game changer. To kick things off, a quick story. Imagine a bank vault representing Bitcoin custody. Institutional money walks to the vault, but sometimes they just step back and rebalance, not withdraw. That small step back can look like panic on TV, but the plumbing tells the truth. Remember that vault story? First, what ETF flows measure? These flows show money moving into or out of ETF shares, not direct on-chain Bitcoin movements. Ts use authorized participants to create or redeem shares, Ks against baskets of Bitcoin held in custody. So flows reveal demand for the investment vehicle. It's not necessarily instantaneous changes in on-chain supply. Second, why did $410 million leave? There are 3 pragmatic causes. A profit-taking after a run. B. Rebalancing and hedging by institutions. C. Large options, expiries, and derivatives desks, forcing delta hedge adjustments. This move was concentrated. BlackRock's IBIT and Fidelity's FBTC led the redemptions, which suggests big institutional order flow, not retail panic. Now the media will scream institutions are exiting, but that's too simple. Heavy ETF outflows can create short-term price pressure because ETFs are liquidity conduits. A redemption means a market sell somewhere. Yet the bigger risk is a liquidity mirage. On calm days, ETFs look like deep liquidity. On stress days, that liquidity can vanish quickly. That's the real threat to price stability. Third, winners and losers. If flows continue, miners and OTC desks feel the pain because they supply actual BTC liquidity. Custodians and APs often absorb temporary flows. But at scale, that raises financing costs and margin calls. The real structural winners are diversified custody providers and market-making firms with balance sheet depth. Here's the game-changer signal I promised. Watch the 7-day cumulative flows and custodian reserve changes. A 1-day $410 million move could be noise. But if net flows stay negative over a 7 to 30-day window, and custodians report withdrawals of actual Bitcoin reserves, then institutional conviction is crumbling. Short of that, this is likely repositioning. Finally, macro and policy. Standard Chartered and other big houses just adjusted forecasts after the sell-offs. That adds to narrative risk. If macro hedge funds rotate out of risk assets, ETFs will see spillover. This is the intersection: macro funding, options expiry, and ETF mechanics. If you're watching this as an investor or creator, a check 7/30th day cumulative ETF flows. B. Watch AP custodian reserve notices. C. Follow derivatives expiries and delta hedging flows. If 2 of 3 trend negative, raise alarm. Not, this is a volatility event, not structural capitulation. Bottom line, $410 million outflow is a headline that matters, but context matters more. This could be a temporary defensive rotation or the start of a trend. The difference is in the plumbing: flows, custody, and derivative positioning. Which signal worries you most: flows, custody, or derivatives? Comment 1, 2, or 3, and I'll pin the best replies. Subscribe for daily economics explainers. Economic, no spin, no hype.